negative $21.44 per share for full year 2025. $640 million in free cash flow. Same company. The write-down's not real, and that's what we're going to prove today. I'm Shinsky, and today's video is on Concentrix, ticker CNXC. If you've been watching this stock this quarter, probably gave you a lot to think about. So let's get into it. Before we touch the numbers, let's make sure we are all on the same page about what Concentrix actually does. Because a lot of the confusion around the stock comes from people not understanding the business model. At its core, Concentrix is a customer experience company. They are the people who answer the phone when you call Apple support, when you call Bank of America, when you have an issue with Samsung. They do that for more than 2,000 enterprise clients across the globe. But here's what's changed in the last 18 months. They're no longer just a call center. They've built an AI product suite called Z Hello for self-service automation. Z Hero is for augmenting human agents, and they're deploying that on behalf of their clients. AI bookings more than doubled year over year in quarter one. Technology wins were up 61%. Z Hello is at $60 million in annualized recurring revenue. They're targeting $100 million by the end of the year. Down at the bottom, the technical snapshot, stock is at 25.88. That's below both the 50-day and 200-day moving average. 52-week range is 22.05 to 62.14. We're currently sitting near the floor of that range. Keep in mind when we get to the entry points page. All right, the quarter. Let me give you the top line read. Revenue came in at $2.5 billion, up 5.4% year over year on a constant currency basis. That's 1.9% growth with a 75 basis point tailwind from FX. That was essentially in line with estimates. Adjusted EBITDA, $348 million, margin of 13.9%, consistent with the prior year period. Adjusted EPS is $2.61 against an estimate of $2.65. That's a 1.3% miss. Not catastrophic, but the market didn't love it. Now, the number everyone's talking about, GAAP earnings per share, 33 cents this quarter. And for the full year of 2025, GAAP earnings per share was negative 21.44, like we said before. That is a number that's been terrorizing this stock. We're going to explain exactly where that comes from. 6-month price performance. CNXC is down roughly 45%, while the S&P 500 is essentially flat. That divergence is a signal. Before I walk through the income statement, there is something buried in this filing that I have not seen a single person talk about. I'll get to it in a few minutes, but keep watching. So let's work through the income statement because there are at least 3 things here that the market is either ignoring or misreading. Revenue $2.5 billion. Banking and financial services was the standout, up 13% year over year. Technology and consumer electronics down 6%. Healthcare down 6%. The mix matters. The verticals that are growing are exactly the ones that use complex, high-value interactions. Gross margin was 34%, down from 36% a year ago. That's 210 basis points of compression. This is real and it's worth watching for us. Adjusted EBITDA, 348 million. That's 13.9% margin, holding flat year over year. Management is executing on the cost side. D&A approximately 112 million this quarter. That is a non-cash item. No cash left the building. It shows up in the GAAP numbers, but it does not represent cash going out the door. Stock-based compensation, approximately 30 million this quarter. Annualize that, you're at 120 million per year. At a 1.58 billion dollar market cap, that is 7.6% annual dilution from compensation alone. That is a real economic cost, even though it's non-cash. And then GAAP net income this quarter, 21.6 million. But for the full year of 25, GAAP net income was negative 1.3 billion. And every single dollar of that loss is from one thing. Let me show you what that thing is. So the balance sheet. Let's be honest about where this stands. Cash, 222.7 million. That's down from 327 million at the prior quarter end. But CFO Andre Valentin explained this on the earnings call. Quarter one free cash flow was negative 145 million due to accounts receivable timing. Full year free cash flow guidance of 630 to 650 million was not cut. Total debt approximately 4.5 billion gross, 4.3 billion net. This is the risk. All of this recourse, meaning if the business deteriorates, shareholders feel it. There is no project level ring fence here. Long-term debt of 4 billion plus, short-term of 500 million minus cash 223 million equals just about 4.3 in net debt. 4.3 billion in net debt. In February, they refinanced 600 million of notes that were coming due in August of 2026 with new notes at 6.5% due in 2029. That removes the near-term debt cliff, but net leverage is still approximately 3x adjusted EBITDA. Management is targeting below 2.6x by this year's end. Capital allocation. In Q4 2025, they repurchased 1.3 million shares at an average price of $42.48. The stock is now at $25.88. They bought at 42 and are telling you it's undervalued. That means something. That's meaningful. A dividend of 36 cents per quarter. That's $1.44 annualized. At $25.88, that's a 5.56% yield. Raised 5 years consecutively. 640 million in guided free cash flow covers that 88 million annual dividend 7.3 times. The dividend is not at risk unless free cash flow misses really badly. I want you to read these words on the screen. These are the exact words from the 8K filing, January 13th of 2026. So let me translate it. Concentrix paid roughly 5 to 6 billion to acquire a European company called WebHelp in September of 2023. Their stock price has since collapsed and over $100 a share to 25. Accounting rules require them to write down the value of what they bought to reflect the current market value. This is called a goodwill impairment. Not $1 of cash left the building. The bank account did not change. The operations did not change. The clients did not leave. The cash flow did not disappear. What happened is that the accounting entry had to be reduced on the balance sheet. That reduction flows through the income statement as a loss. It makes GAAP earnings per share look like negative $21.44, but the cash business generated $626 million in free cash flow in 2025, a company record. But they won't tell you that. The market read the headline, and then they sold, and they never read the footnote. That's the entire thesis in essentially one sentence. Two more things from the filings that matter. Footnote 2, the GBL stake sale. On April 29th, 2026, a company called Group Brooksles Lambert, GBL, sold enough of their Concentrix position to drop below a 50% threshold, triggering the resignation of their board-nominated director. So who is GBL? They're a Belgian holding company that owned Webhelp. When Concentrix acquired Webhelp in 2023, GBL received a CNXC stock as part of the deal. They're now selling that stock at a significant loss. This is the original seller of the acquired business exiting. It's not routine insider selling. It's supply overhang. Footnote 3, the Q1 free cash flow reversal. So adjusted free cash flow was negative $145 million in Q1. The CFO said explicitly, quarter-end receivable timing. For Q1 is reasonably the weakest free cash flow quarter for service companies. The annual guidance is $630 to $650 million. That guidance was not cut. If Q2 is positive, and it should be, the annual number should be intact. The 6-month news log and the risks you need to know about. The goodwill impairment in January, we covered that. The $600 million debt refinancing in February, important, extends to the maturity runway. Q1 earnings in March was revenue beat, EPS slight miss, and full year was maintained. The GBL stake sale, supply overhang, not an operational impact. Now, the risk that keeps some investors away from the stock is AI volume displacement. Companies like Microsoft with Copilot Studio are now able to automate tier 1 call volume. Password resets, order tracking, account balances. The realistic displacement risk to Concentrix is in the 30 to 40% range of current interactions. Here's the question the market has not fully answered yet. If Concentrix deploys zHello, their own AI agent, to automate those same interactions on behalf of their clients, is that revenue loss or margin expansion? Because the client is still paying. The labor cost is just gone. That is the pivot. And that's the reason the bear case and the bull case are both legitimate. So where does the trajectory point? Banking and financial services is up 13% year over year. That vertical is expanding its digital transformation, spending, and Concentrix is benefiting. Retail, travel, and e-commerce up 8%. those are the bright spots. The AI story, zHello, is at 60 million ARR, targeting 100 million. At 100 million ARR, growing at an even 20% annually, that starts to look like a SaaS business inside of a service company. Management credibility. This is the question that determines how much weight you give the guidance. Full year 2025 guidance, they beat it. Revenue exceeded the top end. Free cash flow came in at $626 million. Q4 2025 buybacks at $42.48, above the current stock price. They're buying what they are calling, or they're buying what they're calling undervalued. That's a real action, not just words. The watch item, they guided for stabilization in tech and healthcare verticals. Those are still declining, down 6% each in Q1. That's the area where I'd want to see more improvement in Q2. Overall, their credibility score is about a 7 out of 10. Slightly above average. The free cash flow track record is really the anchor. So the 3-tier comp. Each tier answers kind of a different question. Tier 1 is your direct peers. Concentrix trades at roughly 3 to 5x enterprise value to EBITDA. TaskUs is at 2.7x, smaller, growing faster, about 21% EBITDA margin. Genpact is at 8.3x. Analytics heavy commands a premium. Teleperformance, their biggest direct competitor, is at roughly 3.5x, and their stock is at a 7-year low. Tier 2 is aspirational. If Concentrix AI pivot works, what does the prize look like? Accenture trades at 8.8 enterprise value to EBITDA, with a 121 billion market cap. At 8.8x applied to Concentrix EBITDA, implied equity value is approximately 7.9 billion. Current equity value is 1.58. That is the bull case. And then you have tier 3, the strategic contrast. So Palantir is $285 billion market cap, 145x enterprise value to EBITDA. They sell AI to enterprises. Concentrix operates AI on behalf of enterprises. Same AI spending wave, completely different position. Palantir builds the tools, Concentrix runs them at scale. The valuation work. We ran 9 separate frameworks on this company. The discounted cash flow on core services contributes approximately $38 per share in unlevered enterprise value. The discounted cash flow on AI Suite or Z Suite, approximately $55 per share in enterprise value. BPO Digital, $18 per share. But what's important, these are enterprise value contributions per share, not equity values. Add the 3, so 111 gross enterprise value per share, subtract net debt of 4.3 billion, roughly $70.50 per share, and you arrive at a SOTP equity value of approximately $40 to $42 per share. That is the conservative floor, give or take. Enterprise value to EBITDA at 5x implies $43 per share. The model I weigh most heavily is price to free cash flow. At 10x applied to 640 million in guided free cash flow, the implied market cap is 6.4 billion. Dividend by 61 divided by 61 million shares, that's $105 per share. Against a current price of $25.88. The dividend discount model implies $26 to $28 per share. The EPV goes negative because the leverage is so large. That's the honest bear case we have. Blended weighted intrinsic value turns out to approximately be $47 to $55 per share. Entry points, if it were to fall aggressively down to 22 to 26, if you're really patient, 18 to 22, but if you see a catalyst below 30, after Q2 confirms that free cash flow is on track, you could really enter at pretty much any point. And I personally have taken a small position as we are now. So, not financial advice. Okay. Let me build the sum of the parts from scratch, because this is where I want to be completely transparent about every assumption. The reason I'm using a sum of the parts model is that Concentric's 3 business segments are at fundamentally different stages. Collapsing them into one number would obscure more than it really reveals. Segment 1 is the core services. $9.07 billion revenue is their base. Signed multi-year contracts with anchor clients. I'm discounting this at a 10% WACC and applying a 4x terminal EBITDA multiple. Conservatively pricing in long-run AI distribution risk. Segment EV contribution approximately $2.3 billion. Segment 2 is the AI Z Suite, currently $250 million in estimated revenue. AI bookings doubled year over year. I'm discounting this at 12%. Consumption-based, not fully contracted, real execution risk. Terminal multiple of 12x. Segment approximately $2.7 billion. Segment 3, BPO Digital, $400 million revenue base. Approximately $48 million EBITDA at 12% margin, 12% WACC, 7x terminal. Most commoditized, which is also the most exposed. So it puts at approximately $364 million. And then the combined EV from the 3 segments, approximately $6.8 billion. Subtract the $4.3 billion in net debt. Equity value approximately $2.5 billion per share. $2.5 billion per share is approximately $41. The sensitivity table shows you that what happens when free cash flow guidance and AI growth change simultaneously. At $550 million free cash flow and only 20% AI growth, bear case, $28 per share at $750 million free cash flow and 60% AI growth. The bull case is $68 per share. That range is the honest answer. Anyone who gives you a single number without a range is selling you false precision. So our range is 28 to 68, give or take. At 41 SOTP versus today's 2588, the model implies approximately 58% worth of an upside. But the upside requires 2 things: $640 million in free cash flow that the free cash flow guidance holds, and that the AI Z scaling story is still real and that they're going to continue on that. So, what does the street think about this company? We have a small analyst coverage group, about 4 to 5 firms. The range is wide. JP Morgan has a price target of $55, but an underweight rating. Skeptical, the deleveraging path is as smooth as management suggests. Baird has a buy at 52. Barrington Research has an outperform at 62. Deutsche Bank has a buy at 80, the highest on the street. Morningstar's fair value estimate is approximately 50. The consensus mean is approximately 60. Every single firm has a price target meaningfully above the current stock price of about $25 to $26. Wide analyst price target ranges are content. They tell you that analysts fundamentally disagree about which assumptions drive the value. JP Morgan thinks the leverage path is too long. Deutsche Bank thinks the AI re-rating is real. The disagreement is exactly the right question to be asking. Short interest is approximately 5 to 6% of float. Days to cover is estimated at 3 to 5 days. Not really a thesis changing signal there. So the bottom line. Bear case, $12 to $18. The tech and healthcare verticals don't stabilize. Clients begin bypassing concentrics for in-house AI. Gross margin continues compressing. Free cash flow disappoints. The $640 million guidance. Net debt, covenant pressure builds. I give this a 20% probability. The base case, $38 to $52. Revenue grows 2 to 3% annually. Free cash flow hits $630 million to $650 million on schedule. Leverage drops below 2.6x by year end. Z-Hello reaches 100 million ARR. The multiple re-rates from 3x to 5 to 7x as the AI pivot gains credibility. 55% probability. And the bull case, $65 to $80. Z-Suite ARR scales to 300 million and or above. Outcome-based pricing becomes the industry standard, and CNXC leads it without much competition. Leverage pays down aggressively. The stock re-rates toward the Accenture range. We're going to say about 25% probability for the bull case. So, the takeaways. The $1.52 billion GAAP loss is 100% non-cash. The cash business generated $626 million in free cash flow in 2025, a record. These are not the same number. At $25.80 a share, you're paying 2.5x annual guided free cash flow for a $10 billion revenue Fortune 500 company with 2,000 enterprise clients. The AI displacement bear case is real, but Concentrix is the one doing the displacing. With Z-Hello on behalf of their clients, every agent they replace is margin they keep. Watch Q2 free cash flow. If it's positive and full year guidance holds, thesis intact. If free cash flow misses, the leverage becomes the story very fast. And Z-Hello reaching 100 million ARR by the end of 2026, and banking vertical would need to continue to outperform are the two major indicators to track. Now, I want to give a huge thank you to CDN Ricky Bobby for working through this one with me yet again. You can find the link to his X profile in the description down below. Go give him a follow. He does some really great work. And a quick reminder, CDN Ricky Bobby and I are not financial advisors. Everything in this video represents our personal research done as a hobby. Nothing here is a recommendation to buy, sell any security. CDN Ricky Bobby is not liable for any investment decisions you make, and neither am I. Please do your own due diligence. If you got something out of this, like, subscribe, drop your take in the comments. What's your position on CNXC? Are you buying the AI pivot or selling the leverage risk? Do you have a recommendation for a company that we should look into? We read every comment. Thank you. See you in the next one. Before you go, if you want to institutionalize your research process, consider securing lifetime access to ALSTOCKTRADES. Founded by Dr. Albert Allen, the platform gives you permanent, uninterrupted access to over 60 advanced analytical tools and more than 40 years of historical data, all without any necessary recurring subscription fees. To lock in this long-term value, click the link in my description down below. Use code DRAGON at checkout and take a massive $2,300 off your lifetime membership. Replace market speculation with objective, data-driven conviction today. I'll see you in the next video.